I feel that I've my opinion and my beliefs, and I want to share with you. And you really need to know your own financial objectives, okay? And your own risk tolerance. For example, if I were to sell a stock, okay, it doesn't mean that the stock is bad. It may be that I simply want to reduce my exposure. Or if I buy a stock, it doesn't mean that everyone must buy. Because if I have no position now, I'm not in the market, I buy. But if you are already spent 8 bullets out of your 10 bullets in already, then I think you better hold on. All right, so everyone is different. So you got to know your own financial objectives, your own risk tolerance before you pull the trigger. Okay? Now, today's content is very simple. It's broken up into 2 sections. One, what to buy and when to buy. What to buy and when to buy. Let me first cover what to buy first. What to buy is very focused on FA or fundamental analysis. All right. For myself, I'm very focused on dividend stocks and growth stocks. That is my main focus. If you know me, I like passive income, and dividend stocks do give me passive income. But I want my dividend stocks to be able to grow. What do I look at? Singapore banks, the REITs, the large cap blue chips, but they must have the ability to grow. All right, this is very, very, very important. The stocks that I am looking at, what to buy, my watch list, my potentials, must have the ability to grow. Those in the stagnant market, even though if they pay good dividends, I'm not interested. All right. I'm also very interested in technology stocks, the Chinese stocks that is in technology, like Tencent, those in Hong Kong, and those listed in US. Today, my focus is on dividend stocks, and it is well received. I may in the future cover other topics, other webinars such as on growth stocks. All right. So today, very much focus on growth stocks and on Singapore. All right. Today's presentation is on Singapore growth, dividend stocks that can grow. Now, there are 800 Singapore stocks and 44 Singapore REITs. How to narrow down to something that is manageable? All right, there's so many of them. Now, basically, I have 10 general rules, and applying these stringent rules, in fact, there's only left a couple standing in the end. All right. Okay, without much further ado, let me continue. The first rule, all right, for myself, I avoid companies whose market cap is less than 500 million. In fact, with 500 million, it will be from the 800 over stocks. If you apply this rule of the market cap, those stocks that's above 500 million in market cap, you are left with only 180 stocks. Only 180 left. This is what I apply generally, but in this market where everything is in a crisis, in a recession, all right? In fact, I'm using something more stringent. I apply 1 billion. In fact, it's not just 500 million. I want stocks that's more than 1 billion in market cap. And I'm only left with about 100 stocks now. Okay? Applying this rule, I'm left with only 100 stocks. Okay? Now, why do I want only large cap stocks? Now, there are many trainers and teachers who like small caps, and I do not disagree that small cap stocks have a higher risk, higher chance of a reward, but it has higher risk. But in this market, because it's a crisis, I want to be careful. So I go for large cap because large caps are more likely to survive a recession. All right. And the price of large cap is more likely to recover faster. Not that small cap is no good, but for the time being, I want to be in large cap so that I may sell all my large cap in the future to buy the smaller caps. All right. There may be a second wave where the next wave will be smaller cap that will rise in price. But currently, my focus is on large caps. Now, what does this mean? It means that for the REIT side, probably I will not be focusing on Sabana, even though the current Sabana, under the new management, is to me a good company. All right. For example, even Soybean REIT is giving about 10, 11% dividend yield, but not interested because the market cap is just too small. All right. Now, the next rule that I'm using is I avoid companies that are in difficult sectors. For example, all right, I will not buy a Link REIT, Singtel, StarHub, Asian KTB, Comfort, Delgro, and no HPH Trust. Now, some of these companies, they are really good. Singtel is strong, Comfort, very little debt, all right, but I will not buy them because they are in a difficult sector. Comfort has a major competitor, Grab, that is burning money for marketing like nobody's business. All right. And even though Comfort has deep pockets, I think for the time being, the competitor is just way too strong. All right. Netlink Trust, very good company, but I do not think it can grow. All right. It's probably going to stay the same amount of customers and stay about there. All right. And that's it. Because the market is Singapore and a bit overseas, but mainly Singapore, the size is just too small. I don't think it can grow. All right. Singtel, very solid company too. But I really doubt Singtel and StarHub will be growing. That is my view. All right. I'm in the shipping company, HPH Trust. HPH is in the shipping. That is definitely not a growth sector. All right. So the ports, definitely, the Hong Kong port especially, the Hong Kong port is definitely not going to grow with ports coming up everywhere in Asia. So it will not be growing. All right. These companies pay good dividends but have little upsides. And even the dividends may not be sustainable in the long run. So not for me. All right. Third, if you notice, I think my clients may have noticed that I don't really like hospitality REITs. All right. Even though they pay good dividends, I do not like them. Why? Because they are cyclical in nature. The moment something happens in the market, whether it's a tsunami, whether is it a terrorism, like in this case, epidemic, they are hit. All right, they are the first to be hit. So there's a risk premium. If you buy a hospitality REIT, you must demand a very much higher dividend yield because they are the ones that are going to be hit first. Okay, and I don't like that. No Genting and no Escort for me. All right. And another way to think about it, you know that for REITs, most of the retail REITs, their tenant lease expiry is at least 1 year. If not, some of them is 10 years. All right. Some 5 years, 2 years, but it's in years. What is the lease expiry for hospitality REITs? It's in days. It's in days. At most weeks. Okay. And at this point now, the hotels, they have no customers except the governments, all right, that are trying to, for the SHNs and all that. So they have no customers at this moment. I also avoid commodity industry for the same reason. You know, when I started investing years ago, I will look at, wow, those counters related to oil industry, for example, Golden Agri, okay, Olam, all right. But nowadays, no Olam, no Wilmar, no Sembmarine, no Sembcorp, no commodity-related companies for me. Okay, even though the oil price is so low, it's so cheap, but I just want to be safe. I'm conservative. I don't know about you. I don't want to be in this industry for shares. But you know what? For bonds, I will gladly buy Wilmar bonds, Olam bonds, Sembcorp bonds. All right. Bonds is not an issue. All right. Because bonds, you just want a stable company. The criteria that it grows is not important. You just want a company that's stable. All right. Another issue about the commodity industry is the profit is very, very low. Low profit margin. All right. The moment 1 year there something happens to the industry, easily it will be a money losing year. I avoid airlines right from the start. I've not bought SIA. All right, I don't like. All right, and for multiple reasons. Cyclical, is exposed to natural disasters. But one more thing that I did not write here, it is exposed to 3 major competitors that has bottomless marketing power. Etihad, Emirates, Qatar Airlines. These 3 companies are not listed. They are funded by Arabic princes. They spend money like nobody's business. All right, and SIA is playing the same field. So it's tough. It's going to be tough for them to grow against competitors that is unfair. All right, just like Grab, Comfort against Grab is unfair. Okay, so no SIA for me, no SIA and engineering. No matter how much Temasek is in, I will not buy SIA shares. I'm open to SIA bonds, all right, okay. But SIA shares doesn't have the criteria that you will grow, so no, it's out. Now, no creative restructuring to boost yields. So the REITs that I buy, I do not want them to provide income support. All right. The moment a company has income support, even though there's a reasonable reason, I think I will run away. All right. Okay. A good REIT shouldn't be providing income support. All right. And then there are some REITs that the cornerstone investors agree not to take dividends for a period, just to give a better dividend yield to the clients, to the investors, sorry. No, that's not for me, all right? So for example, so some of the no REITs, no Keppel REIT, because the income support, no EC World. EC World is a very good REIT. I like EC World for multiple reasons, but they are providing income support. And because of that, there are so many stocks that on discount now. For the time being, I will avoid EC World. And definitely no BHG trust for me, because BHG currently now, the cornerstone, the investors are not taking dividends for this period. All right. So to me, it is manipulated. All right, to artificially boost the yields. Now, for the retail malls, I do not know. I do not want any malls that's related to Orchard Road. Why? Because the tourist traffic, the Orchard Road malls depends mainly on the tourist traffic. All right. I much prefer suburban malls rather than malls in the city. The suburban malls do not depend on tourists. Okay. So basically, no SPH REIT for me. SPH REIT has a Paragon. Star Hill has the Ngee Ann City and Wisma Atria. Lendlease had the Somerset 313. Very good, solid 3 REITs, but not for me during this period. Alignment of interest with shareholders. I have on the chart here on the right, perhaps it's too small. It says cost in managing REITs. And the column here are it's a REIT and the fee as a percentage of the revenue. The first one here is Keppel REIT. Keppel REIT 24%. What this means is Keppel REIT is the highest, 24. The fee that they are paying themselves as a percentage of the revenue is 24.7%. Okay, to be fair, this is 2015. This article was taken from the Straits Times in 2015. And at 2015, Keppel REIT was paying 24 to 25% of that to the REIT manager of the revenue. All right. So 25% of the revenue is paid to the REIT manager. So it's quite ridiculous. Now, guess for 2019, what is the amount for Keppel REIT? 20%, still the highest. So for this whole REIT here, the highest, no Keppel REIT for me, simply because they are taking 20% of the revenue for themselves. All right, and all the median for is 7%. All right, most of the other REIT, the management fee is 7% of the revenue. Okay, so to be fair, Suntec here is over here. Suntec is 15%. Last year it was about 12%. All right. So so for myself, I'm not going to Keppel REIT. Now the next one is our sponsors and directors, shareholders. Cromwell and Eagle Trust. These are two REITs where the sponsors and directors is 10% or less. Too little. I would want the sponsors and directors to have 30%, 40%, 50%. All right, where they have skin in the game. They have skin in the game to be shareholders with the REITs at the same time. All right, so not these companies. Next, I would want the DPU and NAV per unit. DPU means, for those who are new, DPU means dividend per unit. NAV is net asset value per unit. All right. They are accretive in whenever they acquire any property or whenever they sell any property. So when I read news, when a REIT buys a property or if they sell a property, I would want that they have a track record of DPU accretive acquisition or DPU accretive sales. Okay, now no Lippo Malls for me, no OUE Con REIT. Let me tell you a bit about these two companies. To me, probably the worst, all right, is Lippo Malls. Okay, Lippo Malls in March 2019, they bought Lippo Malls Puri. Okay, now they bought Lippo Malls Puri. If you check, it is DPU regressive as well as a DPU NAV per unit regressive. All right, this is when they bought Lippo Malls Puri. Now, this year, January, they sold two shopping malls. Lippo Malls sold two shopping malls. Again, can you believe it? It was also DPU regressive. So whether Lippo Malls buy property, they sell property, your DPU get less. So to me, it's completely ridiculous. All right, okay. So they are benefiting themselves. This whole transaction benefits the sponsor. The sponsor is unloading the shopping malls into the REIT. So no Lippo Malls for me, and no OUE Con REIT. Again, also for OUE Con REIT in 2018. 2018 OUE bought OUE Downtown. They were both DPU and NAV regressive. Whereas, there are many strong companies, for example, Keppel DC, Fraser Centrepoint Trust, Ascendas REIT. Just the past couple of years, whenever they acquire properties, they are both DPU accretive and NAV per unit accretive. All right. Whenever they sell a property, it's also accretive when they sell a properties. So they are well-managed companies. Now, I also like to avoid companies that may issue rights. Not that rights is no good, but the fact is that I need to cough out money, all right, okay? And if I know a company frequently issue rights, I will avoid, all right? So there are some companies that frequently issue rights. For example, ESR for the past 3 years, every single year, they issue right. every single year. So if you buy ESL REIT, you jolly well get ready some money, spare money, that because every year they are issuing rights. All right, so it may not be a rights, it may be preferential offering. They will be, if you don't subscribe, you'll be diluting your holdings. Okay, now there is a new REIT, not many people heard of, United Hampshire REIT USD. The market cap is very, very small, something like 300 million. All right, okay, too small. I am sure they will be acquiring new properties in the near future, and whenever they acquire, they will be issuing rights. Okay, so I'm not getting into such companies. All right, now I said 10 rules. 10 rules is a lot. Now, I have a cheat sheet for people who are lazy, and in fact, I'm quite lazy myself, and I use this rule the most frequently, and most of the time, 90% of the time, it works. If a REIT or a company, whether a REIT or company fulfills this requirement, most of the time, they are good companies. All right. Now, what is it? I consider stocks with rising DPU. Don't need to be REITs, it can be stocks also. All right. Rising DPU, because I believe the management of these companies will outperform other companies in the long run. Okay, in the long run. I give you an example. This past couple of weeks, a number of REITs, the retail mall REITs, they like Suntec, like the Fraser Centrepoint Trust, they issued, they announced DPU. There's like 50% below what they normally pay. All right. But if I believe the FCT, Fraser Centrepoint Trust, their management in the future, when the market recovers, they will outperform other companies, other malls, because they are good managers. I will go for them. I will go for them because I know that they are good managers, because they have a past track record, a consistent track record where they have paid higher DPUs and it's sustainable. Not that paying higher DPU is good. You must check that it's sustainable in the long run. All right. So for rising DPU, it's the most important criteria. And secondly, the DPU must be sustainable. All right. I ask myself, would it rise? Is it sustainable? And even though Genting is greatly undervalued, all right, I really like Genting in the past. I used to trade it, all right. And Escort is a big blue chip. It's a big company, solid company. But if you see their track record for dividends, it is not rising. Unfortunately, it's not rising. All right. Let me move on. All right. Let me give you some what I mean. Now, this used to be Asian Pay TV used to be a company that lots and lots of dividend lovers, they love this company. All right. Okay. They used to pay something like more than 10% to 14% dividend. All right. And I saw clients buying them. Okay. Now, what is this chart? The blue chart is actually the historical earnings per share or earnings per unit. All right, this is a historical. The red one to the right is the DPU, the DPU. So it was very clear. The Asian Pay TV in 2013 here on the first chart, on the first one on the left, they were paying much higher DPU than the earnings per unit. They consistently paid as the 2013, 14, 15, 16, 17, 18. They keep paying high DPU, even though their earnings is unsustainable. Suddenly in 2019, they make an announcement. They reduce everything. All their DPU is reduced. So if you buy today Asian Pay TV at today's price, you get 9%. But frankly, now it's 9%. I think next year it will be less. And 2 years later, it will be even lower. All right, because Asian Pay TV is in the sector broadband and in the sector of cable TV. And I think, I don't know whether you agree with me, cable TV is dying. Cable TV is dying, and instead, it's going to be replaced by Netflix. All right, Netflix or similar companies. Another example, Soybuild REIT. These red bars are DPU that they pay each year. Each bar is each year. On the left is 2014, then 15, 16, then 17, 18, 19, and on the right side is 2020. So every single year, their dividends gets less. So assuming if I were to buy Soybuild REIT now, yeah, I get 11%. But you know what? Next year, it may be 10%. Another year later, it may be 9%. All right. Every year, my yield gets smaller and smaller because what they earn is less. When they earn less, they pay less. All right. So they have a consistent track record of paying less and less DPU. Likewise, cash. Cash is now renamed today. There's an announcement. They renamed to ARA. All right. ARA Logistics. Okay. So anyway, likewise, it is going down. Year on year, the dividends, the DPU are going down. So I'm not going to invest in such companies. Now, this is a very, it's a company, Fraser Hospitality Trust. In fact, Maybank Kim Eng has a buy call on this counter. All right. And one of the reasons he has a buy call on this counter is that if there is a privatization, if there's a privatization, all right, if Fraser H Trust take this company private, they privatize it. In fact, the land value itself, just the land value of what they own, is worth more than the hotels. Today, the land value of Fraser H Trust, where it sits, the land and not the hotels, is worth more than the hotels now. All right, okay. So there is this possibility of a corporate action. All right, okay. But if you're investing the 9.1%, assuming they can pay 9.1% this year, because 9.1% is based on the past year, the previous year's dividend payment. All right, but this year will be a bad year. But frankly, in the future, next year, following year, I think it will go lower and lower. I've used an example here, all right, okay, because I cannot help it. Now, I will be fair to you. I'm already an investor of Link REIT, and in fact, I put it down here because I just bought Link REIT just recently, all right, okay. I just bought it for myself recently, and Link REIT is not a Singapore REIT, it's a Hong Kong REIT, all right. And if you see the past 10 years, their dividend payment has been increasing. And this year is at 4%. But you know what? If I get 4% this year, next year, it may be 5%. Following year, it may be 6%. Every year, their dividends, their DPU keeps increasing. This is such companies that I like. Now, for some of you, okay, I just want to spend one slide to tell you more about Link REIT, all right? Just one slide. You bear with me. Link REIT was created in 2005, where the HK Housing Authority, like the HDB of Hong Kong, privatized the shopping malls and car park spaces within the public housing estate. It's like the HDB, you know, they went to launch an IPO, and all the commercial units, the HDB commercial units and the car parks are privatized. All right, okay. Okay, so it is now Asia's largest REIT. Is worth 25 billion in market cap. Now, Ascendas REIT is Singapore's largest REIT. Ascendas REIT is just 10 billion. Ascendas REIT is 10 billion. This Hong Kong REIT, now this Link REIT is a Hong Kong REIT. It is worth in Sing dollars 25 billion in market cap. All right. And just to tell you, it is mainly 86% in Hong Kong, 12% in China, and 2% in Australia. 74% is retail in the retail sector, 17% car park, and office 9%. So the price has dropped a lot. The price has dropped a lot, and that is, and why does it drop? Because it's mainly retail. All right. If there's no COVID-19, if the retail market in Hong Kong is not bad because of the protest, it will not be dropping. All right. And one more thing, there's no rights issue for the past 10 years. All right. Okay. Because they have a lot of money, there is no fear of, no need to issue rights in order to acquire properties. All right. Now, I think most of you who are my long-term clients know, Mapletree Industrial Trust is my all-time favorite REIT. It is a REIT I've been holding for years, and whenever I have a chance, I will buy some of it. All right, okay. It's something that I like. So is now to tell you why do I like Mapletree Industrial Trust. If you see here, DPU has been increasing consistently. They've been increasing their DPU, and the main reason why is because the DPU keeps increasing. I bought a few years ago, and I keep adding, and it's always increasing. And I'm very happy that it used to be focused just on industrial REIT, and today in 2020, if you go to their website, you check that they now declare themselves they are industrial REIT and data center REIT. So going forward, it's not just industrial but data center. So I foresee them acquiring data centers because that is in their vision statement right now. Okay. Now I want to switch now to it's a tool that I use frequently, and it's called usavvy.com. Okay, so I click on it, and actually you heard, for some of you who were early, you heard Richard's voice. Richard, who's helping me in this webinar, actually he is the owner of this website. Okay, now for those who are not members, you will need to register. All right, you will need to register. To register is free. Okay, and I'm already a member, and it's free. So membership is free. So I just log in using my account, and after I log in, I will just click on here, read screener. All right, okay. The website is app.usavvy.com. All right, Richard calls it the world's fastest REIT screener. So by default, this is what you see. It's already sorted by TTM yield. This is by dividend yield. All right, this is by dividend yield. Okay, now why do I like it so much? Because I like to look at the DPU, all right, to analyze the DPU payments. So for example, at the search screen, I just put Maple, all right, Mapletree, and straight away on the I will see the 4 Mapletree REITs here, the 4 of them. Now, Mapletree Industrial REIT is the third one. On the extreme right under the quick links, can you see my mouse? I'm not sure whether you can see my mouse is on the right side. You see the D, and I press D. And this is on a quarterly basis. Each bar is the quarterly basis, the cents on a quarterly basis paid by Mapletree Industrial REIT. As you can see, it just keeps increasing. Only a handful of REITs have this pattern. Most of them is stable. I want to admit, Suntec REIT, Escort, very good companies. They're all stable. All right. But Mapletree Industrial REIT just keeps going up. Okay. Another example, Mapletree Logistics, the DPU keeps increasing. Over here is it drops because of 208. After 208 to 209, it just keep increasing. And Mapletree Logistics keeps going up. And a couple of days ago, they announced that they are increasing the DPU again. And the main reason is their customers are the JD.coms, the China logistic e-commerce companies. All right, okay, and they are tenants of Mapletree Logistics. So these companies, they are still paying. There's no concern about the rental payment. So the DPU, even 2 days ago results, still continue the rise. All right. Okay, let me analyze here. All right, okay. If I want to see just, for example, I want to look at the retail sector, just the retail sector. And the category, I click on the category. There is the checkbox retail. I click it and I click OK. Okay, so straight away, these are the retail malls REIT. All right. And now let me see how I want to sort them. All right, let me sort it by market cap. So I click on the market cap here, and I'm sorted by market cap now. Okay, so you see here the highest is Capital Mall Trust, followed by Mapletree Commercial, Mapletree North Asia Commercial Trust, Fraser Centrepoint Trust. Okay, now let's see from the top. From the top, Capital Mall Trust, I click on the D here. I want to take a look at how are the DPU. Again, you see a drop here, a big drop because of the financial crisis. A big change happened in 2008, 2009. But since then, Capital Mall Trust have been increasing their DPU. It is stable, but it's still increasing. All right, okay. It is still increasing. So I know that their managers, REIT manager, they know how to do AEIs. They know how to do rental reversion to increase value for their tenants, and the tenants are willing to pay higher rental. Okay. Another one, Mapletree Commercial Trust. I click on the D. Again, Mapletree Commercial Trust. The DPU keeps increasing. All right. Now, just a couple of days ago also, Mapletree Commercial Trust also announced result, but they decreased their DPU by 50%. All right. So they are very careful. The DPU will be like 50% lower now. All right. For this quarter. But if you believe that the managers can outperform when the lockdown is eases or is over, I think you can go for Mapletree Com. All right. Actually, I have this read also. All right. Okay. So I'm one of the fans of Mapletree Com. Okay. Last one that I want to show, Fraser Centrepoint Trust. All right. Again, I click on the D on the extreme right. Again, the DPU has been increasing. It has been increasing through the years. Fraser Centrepoint Trust, I like it a lot because this REIT have malls mainly in the suburbs, like North Point. All right. These are malls that are in the heartlands. All right. Not in Orchard Road. So if the lockdown eases, I think they will be the REIT to benefit. All right. Those in the heartland malls will be the first that will benefit. All right. So let me now resume. All right. Resume to my slides. Now, at this moment, let me look at the banking sector. All right. Okay. I want to look at the banking sector in the same way as I look at REITs. This is the DPU from 2010. Each bar on the right, on the left is 2010. On the right here is 2019. All right. So through the years, DBS have been given consistent DPUs, and in fact, they have increased their DPUs recently. They are announcing results tomorrow. All right. I suspect it will be reduced. All right. Their DPU guidance for the future, not for this coming DPU, but the future, they will probably give some guidance to reduce because they are unsure what's going to happen. All right. Okay. But they have a track record of being very consistent. All right. And I dare say, even during a crisis, they will still pay dividend. So far, in all the past crises, in 2009, in 1997, they have been paying dividends through all the crises. All right. Okay. By the way, the rate is special dividend. All right. The other color is the normal dividend. So put them together. All right. UOB, you buy at the current price now, you get 6.7%. Also, I don't know whether you agree with me, the DPUs have more or less have been increasing. Some years it dropped a bit, all right, but generally it has been going up. All right, and it can also they are earning more and more. All right. Likewise, OCBC through the years, it has been going up. This is a chart of UOB's PE ratio. Here is on the left side is in 2010. On the right side is 2019. All right. So based on last financial year, 2019, all right, on today's price, based on today's price and the earnings based on last year, if you buy UOB today, your PE is about 7.5. All right, 7.5. But you know what? As the years go by, do you realize that the PE is going down? Why is the PE going down? PE is price divided by earnings. All right. The price of UOB has been going up. 10 years ago, the price of UOB was probably like $14. All right. Okay. And then it went up to $30. And now it's about 20. All right. So if the PE went up, if the price went up, if the price of UOB has been going up, why is it that the price over earnings has been going down? It's because the earnings is going up more than the price. All right. Okay. So UOB earnings per share has been going up through the years. So many people ask me, will UOB share price go down to the 2009 low? I say not possible. It will not go back to the 2009 low because in 2009, the UOB's earnings is much lower, probably about 1.6 earnings per share. Now it's almost double. The earnings per share is double what they were doing in 2009. All right. Likewise, this is a net asset value of UOB. All right. Okay. It has been growing from 2010 to now. The net asset value is a book value. All right. Okay. If as a reference when they want to privatize or if they go bankrupt, this is the amount what is worth. All right. The net asset value has been growing through the years. So today, will the UOB share price go back to 2010 share price? To me, it's impossible. Impossible because today's UOB's net asset value is much higher. All right. So likewise, the price over NAV. Okay. So price over NAV now is below 1. All right. It's below 1, somewhere like 0.7. If you buy UOB now, the price over NAV is 0.7. And you know what? It keeps going down. It keeps going down because the NAV has been increasing. the NAV, the denominator, has been increasing through the years. All right. And this is what I like. All right. This is what I like. Now, some of you may have heard this word, lower for longer interest rate cycle. All right. What this means is that a lot of reports in the market is saying that interest rate is expected to be stay low for longer. All right. Interest rate will likely stay low for longer. Now, will low interest rates benefit the banks? You guys can't really answer now, all right? No, I'll answer for you, all right? No, all right. For those who know, I'm sure some of you will know, low interest rate will not benefit in the bank. It will decrease their profit margin, all right? Okay, but you know what? I trust the Singapore financial system. All right, I'm biased towards Singapore banks. All right, I trust their management, and I'm in there for the long run. Some of you may say, hey, Ian, should I consider looking at Australian banks? If you buy Australian banks at today's prices, the expected going forward is about 10% yield, all right? 10% dividend yield, okay? Or you buy Bank of China. Bank of China, if you buy at the today's prices, it's going to be 7% yield, all right? 7%. For myself, even though these are good companies, Australian banks and Chinese banks, I would rather have a safe 6.5% Singapore bank and have a yield of just 6.5%. I'm satisfied with it because I trust in the Singapore way of doing things. All right, no good and no right or no wrong, but for myself, I just prefer Singapore banks. Okay, which sector will benefit from lower interest rate? Maybe I pause for a second or two for you to think. Besides what I'm going to give you for some of my answers, you may want to think for yourself, what will happen come June 1st, all right? What will happen in June 1st, okay? I think some of the REITs, the property developers, the tech stocks, the utilities, especially, why? Because they are very intensive to use money. They are infrastructure intensive. Utilities and properties need to borrow money to make money, all right? So when the interest rates are low, they stand to benefit. They will make more. They will make more, all right? Okay. So in this time where the interest rates are low and expected to go even lower, I think going forward, the REITs will make even more money. The banks will earn less, all right? But for myself, because I like banks, I'm still going for them, all right? I'm biased, all right? Now, easing of lockdown is at different pace, okay? I just compiled a list. On the left side, you hear is extending the lockdown. Russia, Germany, UK, US, Indonesia, Singapore, they are still extending the lockdown. Whereas on the right, easing the lockdown is China, Hong Kong, Australia, New Zealand, Vietnam, Korea, and lo and behold, Spain, France, Italy. Now, easing the lockdown sounds good for countries such as Hong Kong, where the number of new cases are single digit. Australia, I'm not sure, but New Zealand is single digit. All right. Vietnam is single digit. I have no problems with them easing lockdown, and but I have a big problem with Spain, France, and Italy, where their numbers, the new cases, is still in the thousands, and they are easing lockdown. All right. Will there be a second wave? Will there be a third wave? I'm not sure. All right. Okay. But for Singapore, I think, I project, all right, keep my fingers crossed. On June 1st, likely there is going to be an easing of the circuit breaker. Who knows? Maybe even tomorrow. Tomorrow, our PM is talking to our country on Labor Day. All right. Okay. Now, I'm not sure, but I think likely June 1st, the numbers should be better, and they would be easing the lockdown probably some of the malls can operate again. I'm just guessing. I'm not spreading fake news, all right? I'm just guessing. And if so, all right, I think the retail malls will benefit. Unlikely they are going to allow foreigners to come in through airplanes. Unlikely the hotels will have more business and more tourists coming in. Very, very unlikely. I think of the three here, most likely are the retail malls. So for myself, I think this is an opportunity for me. All right, okay, for me. All right. I prefer the retail mall. So all things being equal, I think retail malls are good. All right. Of course, unless there's a sell in May correction. If S&P 500 start dropping by 10%, all right, okay, please, I'm sure the retail mall will drop also. The retail mall REITs, all right. But if S&P stay the same price, I think going forward in the next 1 month, likely the retail mall prices will, the REITs of the retail mall will likely recover. Okay, now what is this table that I've compiled? All right, these are the DPU announcements in the last 2 weeks. All right, MIT stands for Mapletree Industrial Trust. All right, they have announced that the DPU for this current quarter is about minus 10%. Okay, MLT, Mapletree Logistic Trust, they have increased their DPU. All right, 1.2%. Cash Logistic, they have decreased by 34%. Even though industrial, if you read some analyst report, they say that industrial REITs are buy now. All right, be careful because they are decreasing their DPU also during this period. ESR decreased the DPU by 50% for this quarter. All right. Now, Keppel DC REIT 8.6, they increased by so much. Why? Because they are data centers. Data centers, they are not human intensive. It is their computers working all the time. All right. Keppel REIT, commercial REIT, wow, increased by 0.7% DPU. Suntec, all right, Suntec is 70% office and 30% retail mall. So their DPU has announced like minus 28%. Mapletree Commercial Trust minus 61% for their DPU. And the last one, all right, the FCT is minus 49%, okay? Minus 49%. Industrial Trust, all right? Industrial Trust, there are many industrial trusts. Out of the many of them, all right, I'm only looking at the biggest industrial trusts. And these are the 4 of them. And among these 4, I like MIT, my favorite. Why? All right. I think it's a sweet spot. If you see the yield, if you buy at the today's prices, Ascendus is 5.8, NLT is 4.69, MLT is Mapletree Logistic, MIT is Mapletree Industrial, Keppel DC is 3.1. I think MIT 5.2 is reasonable, all right? And percentage from the high, 2020 high. That means today's prices, how high is it from the highest price in 2020? Ascendus is still about 22% from the high. Mapletree Logistics is about 17% from the high. Mapletree Industrial is about 22% from the high. Keppel DC is just 5% from the high. All right, okay. So I think it's at the sweet spot. It's at a very nice sweet spot. All right. So that's personally, for myself, my preferred REIT. And frankly, I added to it just 2 days ago. I bought it 2 days ago. All right. Of course, I'm up now. It has gone up slightly. All right. Okay. Okay. Now, retail. These are the retail REITs. All right. Okay. And they are roughly there between 5 to 7%. For those who do not know, CMT is Capital Mall Trust. CCT is Capital Commercial Trust. FCT is Fraser Centrepoint Trust. SPH REIT, all right, SPH REIT. MCT is Mapletree Commercial Trust. And Suntec And the last one is Suntec. All right, okay. Now, if you see, they are still 30%, about 30+% from the high. So retail mall REITs, even though they have recovered slightly, they are still quite high from the 2020 high, because the market doesn't think COVID-19 or life will be the same anytime soon. All right. Okay. So that is why it has not gone up too much. And for myself, all right, okay, for myself, I'm focused just on CMT, Capital Mall Trust. Now, Capital Mall Trust and Capital Commercial Trust, they are actually the same company. In June, they are going to merge. So whether you buy Capital Commercial Trust, you buy Capital Mall Trust, you will end up owning the same company. It will be renamed as Capital Mall Trust in the end. One company. Okay? It'll be one company. Now, basically, it's the same. I have analyzed it already. You buy CCT, you buy MCT at the current price, they are the same. You buy, if you buy CMT now, there's a dividend payment in June, or you buy CCT, there's no dividend payment for the near future, but what you get in the end is the same. So I've done my own analysis. I created Excel. I punch in the prices. Makes no difference. The market has priced in. To me, you can buy either of them. Is the same. All right. Okay. For myself, to keep things simple, I will just buy CMT. All right. CMT. For myself, I'm already holding CMT and I've added to it recently. All right. Okay. So I'm a long time holder of CMT, and I bought some more early 2020. I bought some more, so I have some positions caught on very high. All right, and I recently added it to it again. All right. Okay. So I like CMT, and likewise I had FCT. I bought FCT years ago, and I added to it just recently, as in the past 1 week. All right. Okay. So now the main reason why I like these two REITs are two retail mall REITs, CMT and FCT. Only one reason: they are not in Orchard Road. All right, they are not in Orchard. As simple as that. The other three are in Orchard Road. No, sorry, MCT is not in Orchard Road. Sorry. All right. Now, sorry, and again, I do have some MCT also. All right. Okay. I like MCT, but because of their Video City, they have been punished hard. All right, they have been punished hard because of the Video City for this COVID-19. All right, I like the management, but the yield is not very high. All right, it's not so attractive. Personally, at the moment, FCT and CMT may be better. All right, but please know the MCT managers are very good managers. All right. Okay. Now the hospitality REIT, in the same way, they are still very, very, very far from the high. CDL is still 46% from the high. If you buy at today's prices, it's a 10% yield. 10% yield. All right. Okay. I think if I'm forced to pick a REIT, I will choose CDL. Maybe Escort because it's the largest. But personally, out of these four REITs, I wouldn't be buying the hospitality REITs. Okay. I did not buy it before COVID-19, and I'm not going to buy it after COVID-19. All right. So frankly, even before COVID-19, I do not own any hospitality REIT. All right. And I think the last hospitality REIT I had was Ascendas Hospitality REIT, and it was acquired by Escort, and I don't have it anymore. It's sold already. All right. Since then, I have not bought any hospitality REIT, and I don't plan to. All right. So among the retail mall China REITs, all right, there are two heavyweights here. CRCT is Capital Retail China Trust. All right, MNAC, Maple Tree North Asia Commercial Trust, MNAC. These are the two heavyweights. All right, and I put a Sasua REIT here. I really like Sasua REIT. Sasua REIT is a REIT I'll probably be buying in the past couple of years before COVID-19. All right, when there is very few opportunities in the market, I like Sasua. But because there are so many REITs and companies on discount, I will leave Sasua for the later. All right, okay. And yep, so for myself, it is Maple Tree North Asia Commercial Trust. And why do I like it? I think the yield is reasonable. It's still 31% from the high. They are the retail malls about 40%, all right, okay, and they are about 60% in Hong Kong. Please note, if you buy Maple Tree North Asia Trust, it means that you must have a good feel of Hong Kong, that you believe Hong Kong will recover. All right, okay. So I think Hong Kong will bounce back. Personally, I think they are a very resilient group of people, very aggressive, much more aggressive than Singapore. And they are very savvy, and the things there will recover. All right, recover in the long run. In the long run, they will recover. All right, here it is. This is my shopping mall list for now. And all right, DBS, UOB, OCBC, Maple Tree Industrial Trust, Maple Trust, the CNT or CCT, and Maple Tree North Asia Trust. All right, these are my shopping list.